Hey, what's up everybody? Welcome to episode number 168 here on season number 2. And today we are getting into the compound risk of losing, or I guess maybe like the compound like adversity from losing or something like that. Like, I mean, it's not really risk, it's actually like real money that you'll be losing. This video was inspired out of a few positions that I hold. I was actually looking over my stash account earlier today, which is an app that I use for investing, and there's a specific ETF on there called corporate cannabis, and I had bought this stock or ETF around January, late January at corporate cannabis. Is also the ticker, the ETF ticker is known as MJ on stash, and I had only allocated about $20 into this fund, but it was at the complete high basically of this stock, this ETF MJ. So upon like reviewing it, I noticed that like, hey, you know what, on this stock I'm actually, or this equity ETF, I'm down 33% this year, and I was like, that is terrible. And it was because someone else had shared that they were down, I think like 10-11%. So I was like, oh, well, I'm down 33%. Like, it's not really like it is what it is kind of thing. To say that, like, it's not like my worst holding that I have had or have. Some other holdings that I have been down like 50%, or in some cases even a little bit more, which for me, like, I know to continue to hold those is completely dumb to some degree. Like, I would say at this point, does it really matter? Maybe not so much, but I mean, maybe at like a negative 10% or negative 15% or something like that, like maybe it should have been better for me to close that position. However, that wasn't my strategy. And so now I'm still continue to work my strategy with those holdings. And what I've been seeing is that there's been slight returns coming out of those. The reason that I've been holding corporate cannabis is honestly for a different reason. First of all, it doesn't line up with my strategy to sell. And then second of all, it's for personal beliefs and that kind of thing. So the reason why I wanted to make this video was not in regards to my losses on corporate cannabis. It was more to kind of expose my viewers to the downside of risk and the downside of when your account or holding starts to decrease. And I think that it will actually become more surprising to you by the end of this video. This kind of idea comes from the idea of like cutting losses quickly and then letting the gains continue to run. So if you're in a winning stock, like let that one continue to grow. And if your stock is dropping, like just cut it while it's young, and then boom, there you go. Like you don't have to worry about exactly what we're going to get into. But to kind of like explain it before we get into the chart, basically think about it like this. You have $1,000 that you invest into, say, Snapchat. Snapchat drops 10%, we'll say, in the course of a week, and you didn't sell any of that Snapchat. If you take now you've got $900. If you take that $900 and sell that, and then say you pick a different stock, we'll say that you pick GE, and you're expecting GE to go up or for some reason like that, and you boom throw it into GE, that stock now has to climb 11.11% in order to get back to that break even of $1,000. So you can see there's a little bit of a difference right there. It not only has to go up 10%, it actually has to go up 11.11%. So thus you have to make basically more money off that $900 than you did losing that percent-wise than you did losing that $100. So I hope that makes a little bit of sense. It'll make more sense as we start to look on the screen right now. So this is my risk breakdown chart. There's 3 different quadrants, both in each. There's a loss adjusted account, percent to break even. Then I have if it was to go up, the same amount, and the adjusted account, and then the percent to break even. So basically the amount that you could lose on the way down. And then I have down here basically the difference between it's the percent to break even for loss, and then the percent to break even for a gain, and that's the percent that you get in the negative form. So anyways, we'll go ahead and take a look at the actual losses and adjusted account. So as you can see right now, if you had $1,000 and say you lost 10% of that, it was $100, you would have $900 left in that account. Well, in order to get back up that $900 back up to that $1,000, you have to make a gain of 11.11%. So we'll go ahead and take a look at 20%. Say you lose 20%, it's only twice as much as 10%, right? You would have an account worth $800. And in order for that to grow back up to $1,000, you would have to have 25% gain on that account. At 30%, you would have to have a 42% gain. At a 40%, you would have to have a 66.67. And at 50%, you would have to have that grow 100% to reach that original investment of $1,000. And if you keep on going down, the story gets worse. At 60%, you would have to make back 150%. At 70%, 233%. At 80%, 400%. 90%, 900%. And at 99%, you would have to make back 9,900% of your original investment. So as you can tell, the way that slides, it slides exponentially. And then we'll go ahead and take a look at the actual gain portion of it. So as you can tell, original investment of $1,000, you add 10% of that, you get $1,100. In order for that to drop back down, you can only allow 9.09%. And then as you continue to grow, it actually slows down, which is crazy because I didn't really expect that. So the losses increase exponentially like this. The gains actually decrease as time goes on. So they start to level out. I hope that spreadsheet kind of does a little bit more justice in the way that I explained it earlier on, is that as you can tell, the more risk that you take on, the exponential growth that you need to have on that account. And so that's why typically that like cut your losses quickly comes out of that. For instance, if you take a look at the chart, at 33%, I have to make basically almost 44% back on that original investment in order to break even. And that's not talking about growing. That's just talking about specifically breaking even, being able to sell off my investment and walk out of there with $20 hard like I had when I originally invested. I gotta say this real quick because I know that a lot of people are gonna seriously be like, oh my gosh, I'm down 15%. Like I should just sell tomorrow. Panic sell, get out of this. Like bye, I'm gone. Forget this. Like I gotta have that increased like 17%, 18% or something like that. Like it's not gonna happen. Like whatever, I'm done. Like out. I'm not saying that at all. That's not what I'm saying. I'm saying go back and look at your strategy. If your strategy doesn't include like this knowledge, that knowing this, then put that back in, then redo your strategy a little bit, include that in there and be like, wow, like I didn't even know that the risk on an account like that grew exponentially. So that's what I would do personally. However, for me, that doesn't mean that I'm going to go out and sell any of my investments. I don't think that it's a good idea to go out and make an irrational decision because some dude on the internet says, hey, let you know, risk grows exponentially, growth doesn't grow exponentially. So just some ideas. Like I said, go back to your strategy. If it doesn't fit your strategy and you don't want it to, then leave it out. And if it does fit in your strategy, and for instance, if your strategy says that, hey, when it hits this low, you should be selling, then and it's lower than that, like you probably already should have sold. Like that's the problem that I have with the investments that for me went bad, is that I had a stop loss and I never set it and it just continued to drop, and I should have listened to my stop loss, but instead I didn't. With Stash, I don't have a stop loss. I just let it do its thing. It's a long-term approach for me, and for me it's corporate cannabis. It's not something that I would sell, and that's pretty much in writing stone. Anyways, we'll go ahead and leave it right there. Let's jump into the question of the day really quickly, which is, what's your perfect burger? For me, like, I guess first of all, it's gotta be vegan. So I'm not really like a fan of like the fake like meat patties anyways to begin with. So for that reason, like it's definitely gotta be probably like a bean burger. I don't know, a different kind of burger, maybe like a corned bean burger or a Chipotle kind of burger or something like that. For me, like I said, not a big fake meat fan. Not really into the fake vegan cheese either, so I'll probably just do it with that. I like lettuce, tomato, maybe a little bit of mayo. I would prefer actually avocado or guacamole, just like smothered on that. A ton of barbecue sauce is doused on that. Maybe a little bit of mustard, definitely some grilled onions on top, you know, the ones that are battered and stuff like that. Boom, right there. Maybe, heck, we'll just go ahead and throw some fake bacon on that thing. Some onions, definitely we gotta have some onions, and maybe like 2-3 pickles, like just the way that McDonald's does it with like the 2 pickles that are like smushed up into the bun that are completely gross, but you still eat them anyways. That kind of like pickle, and that would be like, I guess, the perfect hamburger or burger for me. Anyways, we'll go ahead and leave right there. Like I always say, if you've got a question regarding Stash, Acorns, Robinhood, M1 Finance, as well as general investing, business, Etsy, coaching, post those questions down below. Please don't forget to subscribe right up here. Check out these 2 videos right here in the link. And as always, thank you for watching. I really appreciate it.